So today is the 26th of February 2021. I'm Abdullah Mashat. This is Wael and Abdullah. We're from the Finance Memo, and we're here to interview Mr. Will Hershey, co-founder and CEO of RoundHill Investments. So we're very glad to have you, Mr. Will.
Thanks, Abdullah. I appreciate the opportunity.
Of course, and we're looking forward. So the first question is basically an introduction. We would like to know more about yourself, your experience, how you became a CEO.
Okay. Where to start? I guess just a little bit on my personal background. So I grew up in New York City. Both of my parents actually worked in finance, worked on Wall Street. So my dad was at Merrill Lynch. My mom was at Lehman Brothers. Neither of those two firms exist today, unfortunately. But from an early age, kind of took an interest in financial markets. Always had CNBC on the TV. And that kind of laid the groundwork for where I ended up with my career. I went to Vanderbilt University undergrad, studied economics and finance, and after school went and worked for a boutique asset manager here in New York that I had interned with during undergrad, which was focused on energy investing, more specifically midstream. So energy infrastructure investments. And when I started there, it coincided with that firm, Yorkville ETF Advisors was the name of the company, with the firm launching two ETFs focused on the energy sector. So I was obviously very junior at the time, but was involved in product construction. How do you create an index that underlies an ETF? As well as content and marketing, and really got to, I think, appreciate the ETF structure, which I'm sure we'll talk more about today, and why I think it's the best structure for a fund in today's market. But also really got to understand how scalable the ETF business model is and how attractive it was as a business opportunity. So helped launch two ETFs with Yorkville ETF. We raised about $400 million in assets under management in those two funds before selling them to a larger ETF issuer. The partners at that company actually also started and this is 2011, 2012, started a white label platform for ETFs. Our funds were the first launched on those. So not only did I get to see and be a part of launching our own funds, which ringing the bell at the New York Stock Exchange is one of the most fun things. It never gets old. Is how I got to see a ton of different ideas and what worked and what didn't. Fast forward. So after we launched those passive index-based products, I spent time more in active management with a sister company, Yorkville Capital, where we separately manage accounts for high net worth and institutions focused on energy infrastructure. Once again, and energy infrastructure was great as a place to invest up until about 2014, 2015. Thereafter, not so much. We actually launched a long-short midstream focused fund in 2016. I was the head trader for that fund, and in terms of kind of the energy market, I don't need to tell the story about what happened thereafter, but we did end up winding down that fund, and I kind of looked at my opportunities moving forward. I was really fortunate in the sense that during my entire career up until that point, and I was, let's say, 29 at that point, I was part of a small company where, the benefits of that really were that I got to be involved and be part of meetings that were very much so structural to what you need to understand to start a business, and a business really, whether in, finance or otherwise. So long story short, after that fund shut down, I said, I don't want to stay in energy. I don't want to stay in trading. So got together with my now co-founder, Tim, who I've known for a long time, and said, let's start RoundHill. And with the goal being, and tell me if I'm going off too long here, with the goal
not being, at all.
Okay. With the goal being, I think there's something, and just to give you a little more color, Tim and I connected during the kind of boom in cryptocurrency, and we saw younger people more than ever paying attention to financial markets and getting interested in financial markets. And we said, we really think there's an opportunity to leverage my experience from launching ETFs back in earlier part of the decade to kind of go after that and serve that audience. So the kind of concept behind RoundHill was, let's create an SEC registered investment advisor that launches exchange traded funds, ETFs that do it in two important ways. One is really create ETFs that offer differentiated exposure from what else is out there on the market. That was one. And two, let's really focus on content and marketing and investor education as the way to drive people to our funds. And to date, we've been somewhat successful. We launched our first fund focused on video games and esports, which I think we'll touch on today, in June of 2019. We have since launched another ETF focused on online sports betting and online gambling, as well as just a couple weeks ago, the first ever ETF targeting the streaming sector. And in total, since we launched that first gaming fund in June of 2019, we've amassed nearly $700 million in assets under management. And that consists of both self-directed retail investors who want exposure to these themes, but also institutional investors who are looking for ways to get exposure to long-term secular growth trends without taking single security risk.
Very nice, Will. And honestly, your experience with the previous energy sector, I'm sure you mentioned that it went down, but the lessons learned are worth a lot.
So, you're absolutely right. I think the kind of silver lining there was as someone who was actually still in school during the Great Recession and the financial crisis, I still have experience in the scars from going through a bear market in energy. I think oil WTI hitting $26 a barrel in February. What was that? February 2016 was worse in my mind than what we just had. But I totally agree with you, and I think that's definitely been important to kind of manage expectation.
And definitely will. Like oil hitting 26 for Saudi, I'm sure it's even a much worse disaster than for any other ETF. But I wanted to ask you something else we're interested in. You gave us a glimpse on the different ETFs that RoundHill is managing at the moment. But can you please talk more about them in terms of, are they passive, are they active, and more about what differentiates them in terms of comparison with others?
Sure. So we've taken the approach with our first two launches in Nerd, focused on video games and esports, and Bets, focused on sports betting, of an indexed approach. So passive in name. We are self-indexing those products. So I think, historically, the role of an indexer was really to provide a benchmark first and a product second. The industry's kind of shifted in that, the types of indexes that are launched often nowadays are made with the purpose of underlying a product first and foremost, and being a benchmark almost secondary. So in that sense, we wanted to kind of control and own those indexes ourselves. So I guess you could say we're licensing those indexes to ourselves. And that's how we've structured it for those first two funds. For those products, we're utilizing quarterly reconstitutions and rebalances, whereby we're running the screens that we have in place and the index methodology that we have in place on a quarterly basis, which can result in new companies in, new companies out. And I can give more color on how we do that if that's of interest.
Yeah, please. Yeah, we're very interested.
Sure. So, I think what's really important is when you're dealing with thematic equity products. Let's talk about esports more specific as a specific example. There isn't for most companies a line item on their balance sheet or on their income statement or statement of cash flows that suggests here are our esports related revenues. It's not as clear cut as that, nor are themes in the market. So streaming is another example, nor are these themes captured by kind of the current structure of traditional GIC sectors or otherwise. So with that in mind, how do you think about constructing a universe for something for which there is no universe is kind of where we start. And we settled on a process that I had been familiar with before, whereby we utilize document search and screening for the universe of public companies for given keywords that we have that are relevant to a given theme. So what that allows for us to do is look at all global companies, no matter what country they're listed in terms of their 10Ks, their presentations, their annual reports, their 8Ks, for keywords relevant to a theme. So in the case of esports, keywords we might be searching for include competitive gaming or game streaming or esports itself. And that document searching thousands and millions of documents, allows for us to create a framework in which we're able to identify companies that are focused on these areas for growing their business. And that's kind of the first step. From there, we will apply market cap minimums and kind of remove companies, as well as kind of employing a bit of qualitative analysis to bucket the companies. I think that what we do a little bit differently than others is we take an approach in weighting our indexes in that our goal is to provide exposure to the theme. Our goal is not to kind of create a basket that says it does something but doesn't. And I think that commonly what you'll find is indexes that are market cap weighted, whereby simply the larger companies are assigned a higher weighting. We said, okay, well, let's take a look at esports for a second. Amazon owns Twitch. Microsoft owns Xbox. These are core parts of the esports ecosystem. But when you look at Amazon and Microsoft as companies, how big of an impact are those initiatives having on the company's bottom line? Well, it's hard to say, but it's not. Those aren't the types of companies we're trying to provide exposure to. So we're not including those, and taking that a step further, we're really trying to weight companies on the basis of how exposed they are to a given theme, and the end result becomes something that, as best we can, this is not a scientific experiment, but as best we can, provide exposure to what we're saying we're providing exposure to. And that I think is very different from the way that others approach kind of weighting and security selection for thematic products. And just to give you a bit more on the way we're set up, so we have those indexes for the gaming and esports. We have the index for the sports betting and iGaming. New rules came out from the SEC in I believe it was last year or the year prior. It's called Rule 6C11. That effectively allowed for passive and active ETFs. I know we talk a lot about active ETFs nowadays with everything that ARK has been able to accomplish. They basically kind of made them viewed as one and the same. So for our most recent launch, we are active for the streaming ETF, but we're still following the same process. The difference is that there's no index that we are obligated to track. And insofar as we want to be more active, we have that ability. But really, we are, and I think this is really important, we are not fundamental stock pickers. We are not analyzing, Activision versus EA and saying Activision's undervalued, EA's overvalued, let's weight accordingly. We're not making those calls. Our goal is, once again, to provide the exposure to the broad-based theme as best we can with the information that we can get publicly.
The weighting aspect is quite interesting in the ETF space. Most funds just weight according to market cap, which I find to be way too traditional. Could you talk about the process of putting an ETF together, and especially how does market making work? Who does it? What do they benefit? And how does the whole system work?
No, that's a really great question. And just to clarify, I do think there's a place for market cap weighting, but I think it's a place for market cap weighting in, the S&P 500. That's fine to be market cap weighted. That is a representation of the broad U.S. market. It's when you get into these more themes that I think you lose the essence of what you're trying to provide to investors by market cap weighting. But on to maybe I'll start with how an ETF works, and then I can talk about how you launch one. So in terms of the market making aspect, and I think this is really important for those who are investing in ETFs to understand, and I'm sure this will bring up additional questions, but day one, when you launch an ETF, you will launch it with some seed capital. It used to be that you had to launch with 100,000 shares outstanding. So if you were launching at $20, you'd have to have $2 million in seed capital USD. That's no longer the case, but that's how we've launched all of our funds. And day one, the owners of that seed capital, so this is people who hold those shares prior to them being traded on a market, will be typically a market maker. But so day one in ETF launches, right? Or not even day one. In the early stages of an ETF, you go and you attempt to buy 100 shares of an ETF. Let's call it ticker XYZ. When you go to buy 100 shares of an ETF, there's two types of parties that can sell you that ETF. One would be an individual or an institution or whomever that currently holds the ETF and is willing to sell it to you. I think that's a pretty straightforward transaction. You have a willing buyer and a willing seller, and the transaction's complete. In that case, the market maker is not involved, and the buyer now owns the shares, the seller no longer holds their shares. However, very oftentimes, for a given price, or even at all, there is not necessarily a natural or organic seller of the ETF. And in that case, if you go to buy 100 shares of XYZ, instead of buying it from someone who already holds it, you're going to be buying it from a market maker. And that market maker basically is able to utilize arbitrage to be willing to take that trade on their books. So what happens when you buy 100, you put in an order to buy 100 shares of XYZ, there's no natural sellers, so instead, the market maker sells you 100 shares at a price. The price will typically be, for liquid ETFs, very close to the fund's intraday net asset value. And that's really important in ETFs, is to pay attention to the net asset value. So when the market maker sells those 100 shares of the ETF, they once again have two ways of selling it. One, if they have existing shares of XYZ on their balance sheet, it's like the first example. It's a natural buyer and seller. However, if they don't have it, what they will often do is they will borrow shares of the ETF from a party that does own them and sell them to you. So what you have there is you bought 100 shares of XYZ. The market maker borrowed and sold to you those 100 shares. So they are now short 100 shares of the ETF. At the exact same time, or roughly at the exact same time that they shorted those 100 shares of the ETF, what they'll do is they'll buy all of the underlying components of the ETF. So in the case of the S&P 500, they'll go and buy all 500 companies proportionate to the weightings in the S&P 500 index. So now they're long all the 500 companies in the index, they're short SPY or the ETF, and they do that. And the reason they do that is because the market maker is not interested in taking a bet on the direction in which the ETF is going to go. They don't want to be short the ETF and then have the ETF go higher. However, they're willing to be short the ETF and long the 500 companies that comprise it because they're perfectly hedged, right? If the 500 companies go higher, the ETF will go higher, and if they go lower, the ETF will go lower. Now, they'll do that trade again and again and again many times throughout the day. And when they do it enough times, they get to what's called a creation unit worth of an ETF. And for many ETFs, that's either 25,000 shares of the ETF or 50,000. And when they get to that point, so they have a ton of balance sheet that's being taken up, long the underlying stocks, short the ETF. What they'll do is they'll take those underlying stocks and through what's called an authorized participant, deliver all of those 500 stocks to the ETF trust, and the ETF trust in turn will say, this looks good, these are the correct companies and the correct weights. We'll give you new shares of the ETF in exchange for the stocks that comprise it. And as a result, the market maker takes those new shares, they no longer own the underlying stocks. Remember, they were previously short the ETF, and now they've flattened their position. So they have no exposure anymore, and the assets under management and the shares outstanding for the ETF have increased. And effectively what I just described is called the in-kind creation process, where the ETF advisor is not actually doing any trading. The trading is all taking place via a market maker that delivers the underlying stocks to the trust in exchange for new shares. Now, I'm sure that probably introduced questions, but that is the way that an ETF works. And the market maker, the way that they make money is twofold. One is they will, for making a good price on the ETF, they will get paid by the exchanges, something that's called rebates. Those are fractions of a cent per trade. So, but if you do enough of them in something like SPY, they can become meaningful. And then secondly is the spread. So let's say that the basket of the companies is worth $50 per ETF share. Maybe they are selling those ETF shares at $50.05 and buying, when they're sellers of the ETF, at $49.95. And they can capture that spread insofar as they're able to effectively hedge themselves by trading the underlying. Hopefully I didn't go too far into the weeds. But I think
that was very insightful. So just to go on, we're learning so much here.
Yeah, no, absolutely. And I think that it's a common misconception that the ETF advisor is doing tons of trades on a daily basis. A lot of the action in many ETFs is done via that in-kind process, where shares of the underlying components of the ETF are either delivered to or from the ETF, and that is separate from the actual trading that you're doing if you're rebalancing your portfolio or managing exposures in the ETF. And as a result, for ETFs where you're getting a lot of trading, redemptions and creations, it can be a full-time job to really manage those exposures to make sure they're representative of what you're trying to provide to end investors. In terms of, because I know your first question was, how do you launch an ETF?
Exactly, yeah.
So to launch an ETF, I mean, the first thing that you need is a strategy, and that should be obvious. But the strategy can be an index that you've developed. It can be an active strategy that you've that you think you can provide to investors. And that's the very first part is, do you have a strategy that investors want or have value in? And then there's kind of three ways that you can be involved in the economics of an ETF. One is as an index provider. So if you want to create an index and license it to an ETF issuer, they will pay you for that. That's one. Two is if you want to start your own ETF company and be the advisor to the ETF, then you need to be properly registered with the SEC and have procedures in place that allow for you to do that. And then the final option would be to be as a sub-advisor to an ETF, whereby you're really just responsible for only the portfolio management and trading, where the advisor deals with the operational complexity of the ETF. I think without going too far into it, there's many functions that you need to find service providers and partners to work on that happen behind the scenes in an ETF. To give you a few examples, one would be the custodian. Who's going to actually hold the underlying equities that you're invested in? In our case, for our funds, we're investing globally. So when we're buying securities in the South Korean market, we have a sub-custodian that holds our South Korean equities in that country on the behalf of the fund. So custodian is one. Another one would be fund administrator. And fund administrator basically is dealing with those, is helping every day calculate what is the net asset value of the fund, producing the data points that go out, and working with the custodian to clarify what the holdings are. And then there's one other high-level function, which is called a distributor. And this is technically a legal underwriter for the fund, and you're required to have one to list an ETF in the U.S. So once you have your service providers in place, you figure out, am I going to be the index provider, or am I going to be the index provider and the advisor, or am I just going to be the advisor? You can get the ball rolling. And I think you would initially file a prospectus with the SEC. The SEC, and that would outline your strategy, who your providers are, how the ETF is set up. Once you're filed, the SEC, has an initial 75-day review period where they can provide comments. So if we tried and filed for a Bitcoin ETF, I'm sure they would have many, many comments as to why that's not going to happen. And once you have that, let's say the SEC gives you the stamp of approval, and during that time, you've already presented the fund to the board that oversees the ETF trust. I didn't go into that, but probably not neither here nor there. You'll pick a listing exchange. So we've listed all of our funds on the New York Stock Exchange, but CBOE, NASDAQ, BATS, or other options there. And on top of that, there's a lot of other stuff that happens behind the scenes, but it's not as exciting. Then you're free to go live with an ETF. And there are a lot of rules that govern what types of things you can do within the ETF structure. So you can't, for example, launch an ETF and put 100% of your assets into a single company. It's not allowed. And there are other rules that govern what you can and cannot do. I will say that ETFs are not cheap to launch. So between all of those various service providers, you are paying several $100,000 USD per year in order to keep the ETF open. And I think that's why historically you've seen ETFs that have failed to attract meaningful assets under management have been closed over time because they can't get to a point where it's profitable to keep the ETF open. And I know I gave everyone so much there, probably more than they ever wanted to know about ETFs, but it's interesting.
I'm learning so much here, so it's great that you're getting into the details. I think that the Bitcoin ETF is something close that may happen in the United States. So I'm a close tracker of the value trade, right? The classic value stocks.
Mm-hmm.
They've been underperforming for the past decade, let's say. So we've seen them outperforming coming out of the recession. So do you think this will last, or are we just jinxing it at this point? So what's your opinion on it?
Now I'm getting over my pay grade, but I'll give you my uninformed opinion. I think, first of all, I should also mention that we do have an ETF that we partnered with. Once again, if you remember the structure, we are the advisor, we're the sponsor, and we worked with, I don't know if anyone follows him on Twitter, Tobias Carlisle, who's an expert in deep value.
Yeah,
there you go. So
yeah.
we launched an ETF targeting deep value. The ticker is DEEP, DEEP. So we do believe that there is something to that trade. In terms of, I think we're at an interesting point where interest rates are moving higher in the U.S., at least over the short term here. Inflation appears to be something that participants are concerned with. I think that, and on top of everything else, you have value names, which typically skew towards kind of more of a reopening trade, whereby the world's getting back to normal, whether it's energy or financials, or industrials. And I think that the valuations for a lot of growth companies have been very clearly stretched, to put it lightly. And I think that these things are obvious in hindsight. But I do believe that there's a chance that we do see a regime change and a shift away from momentum, high beta growth and technology into more value-oriented sectors. I think it's, unfortunately for the past decade, as you mentioned, it's been kind of a value trap. And I think in that sense, I think that probably because information is so freely available, including for everyone from retail investors all the way up, I think that there's less alpha to be had in traditional metrics in terms of how you measure value, right? I don't think it's as simple anymore as to just say the PE ratio is low for this stock, I'm going to buy it, and expect to produce alpha that way. I think that is one thing I would just add, is that there's so much alternative data and ways of thinking about things. I think the meaning of a value stock has probably changed from what it once was.
For sure. And for the past decade, we've been seeing a lot of different phenomena. So thank you for touching on that. Will, earlier you mentioned that assets under management for RoundHill surpassed 700. So congrats on that milestone. So my next question is, what are certain hiccups or challenges that were faced along the way for reaching that number?
No, absolutely. Thank you. And we're almost at 700. We're not quite there yet, but I hope nice. I hope to be soon. And I think there's a lot of challenges with any business that you start. And once again, that goes beyond if you want to do a startup in finance. It's really just the kind of growing pains of starting a business. I think for us, our plan always from day one was to do things differently than it's done in the rest of the industry. We felt like there was a real opportunity to focus on reaching end investors rather than going through intermediaries like brokers and financial advisors, by effectively focusing on investor education and content. And that was always our plan from day one. But to give you a bit of context, our assets under management in March of last year, so less than a year ago, were actually below $10 million. So we had been doing it at that point for, call it, 8 months, and had seen very limited success. And during that period, we tried things that we said we weren't going to focus on. So we tried doing the traditional distribution model. And there are times when things aren't working that it's easy to try and say that you're going to change your strategy and try different things. And I think that's okay, because you learn a lot from spending time on things that don't work. And that allows you to become more efficient and allocate your time towards things that are working and that are core to your thesis. But I mean, there were certainly times where we were questioning whether our approach and model was correct. I think, if I'm being transparent, and I think this is probably what most entrepreneurs that have achieved some semblance of success will admit, is that I think we got very lucky. I think that the current environment, where more self-directed investors than ever before are paying attention to the market, played into our strategy particularly well. And I think that's been a large reason as to why we've been able to grow so quickly. I also think that it's been really interesting because, I truly believe in Nerd and video games and esports as a long-term thesis, but it wasn't until we actually launched our second fund that we started to get a lot of attention. So I would just offer that, it really is never easy. And there were certainly times where we were questioning if we were doing things the right way. as recently as about a year ago, that was the case.
The competition is extremely high for the ETF business, so it's never easy. So we've just heard of the public investment fund investing $3 billion in the gaming industry. So we want to ask you about the industry itself. So what do you think of the future of the industry, and will the let's say pandemic-induced gamers last a long time, or will we just see the demand decrease?
No, this is actually perfect timing because I just gave a presentation on this yesterday. I think when you look at what happened for the gaming industry in 2020, it was an inflection point and an acceleration of trends that were already in place. But I don't think it was, for example, a one-time blip. I think when you look at the themes and trends that are underlying the growth that we've seen in the gaming industry, they're here to stay. And kind of what I mean by that are games took a step forward in 2020 in terms of being social platforms. People during the pandemic stuck at home really looked to games as kind of that third place, that way to connect with friends or colleagues or family. And I think that continues. I think specifically in terms of competitive gaming and esports and game streaming, we're just getting started. And I think that, if you look at kind of the Korean market or the China market in terms of examples of what esports and live streaming can become, the Western world and potentially parts of the Middle East as well have a long ways to go to catch up to those places. We're also seeing, I can touch on this more in a second, but we're also seeing mobile gaming as being kind of the next area of growth for the industry. I think a lot of gamers who are PC gamers in particular maybe don't consider mobile gaming to be real gaming, but what we're seeing with smartphone penetration rates across the globe, particularly in emerging markets where historically $2,000 gaming PCs or $500 gaming consoles were unattainable, smartphones are now allowing for more people than ever before to interact with games and importantly, to interact with high-quality games. I mean, you can run Fortnite or PUBG Mobile on pretty old iPhones. And that is really going to drive, the numbers we're seeing at a high level even higher. The games industry did probably $160 billion in revenues last year. That's larger than the global box office and music industries combined already, but it is continuing to take share from those mediums. If you have a chance to listen to, I think on their previous conference calls, Netflix has highlighted that their biggest competition for engagement is not Disney Plus or any of the other streaming platforms. It's Fortnite and games. And last year, what we saw was once again really, really accelerated adoption in terms of user growth. So if you look at a chart, and I like to look at two charts if anyone's interested. One is I look at the user growth on Steam as a proxy for user engagement, and then I look at a chart of Twitch viewership as a way to see how many people are watching and people play games. And we've already seen now, I was kind of amazed when I ran the numbers, we're in 2021, we are above engagement on both of those platforms versus where we were in March and April at the height of the pandemic last year. So that to me suggests that a lot of those gamers who maybe came in initially during the pandemic when everything was shut down are continuing to stay and stay engaged in the industry. I can just speak for myself. I'm 31. Friends of mine who hadn't played video games in 10 years have bought Xboxes and PlayStations while they're at home. And I would venture that insofar as a decent portion of those individuals stay as gamers, you have an acceleration of a growth rate that was already taking place coming into the pandemic. One last high-level point that I think is really important for investors looking at the game space, particularly on the gaming software space, so companies that are developers and publishers of games, is we've seen a shift in the business model that continues to take place. When I was growing up, you would buy a game at a store, probably at a GameStop, and you would go home, and the only intellectual property that you'd have access to was whatever came pre-programmed onto the disk. And maybe if you're lucky later on in my childhood, you could connect online and play with friends, but it was really still limited to what was on the physical disk. With advances in technology now and the high-speed internet, which continues to penetrate across the globe, you now have a shift in the business model, which means that game developers no longer have to focus on getting everything onto that one disk and creating blockbuster hits. Instead, they're able to create great IP that lasts again and again and again because they're able to digitally distribute that content as they produce it. And that content, because it's simply digital, it's bits, it's files over the internet, is much higher margins. And on top of that, it's resulted in more recurring revenue streams for the big video game publishers. I always like to look at Take-Two as an example. Take-Two used to be very much so driven off of when's the next Red Dead Redemption, when's the next Grand Theft Auto. Well, if you look at the numbers from last year, I believe that Grand Theft Auto, which was released, Grand Theft Auto 5 was released, I think, several years ago, had its highest revenues ever because they're able to continue to push content out into their existing IPs. This means games last longer. League of Legends is 10 years old. This means that margins are higher, and this means that revenues are recurring. And I think that the market is starting to appreciate that and reward game publishers with higher multiples than they had in the past. So I think that there's a lot of things underpinning probably what the PIF saw in these companies. And on top of everything else, I would venture that given the year that we had last year, I bet that there is consolidation that continues in the industry in terms of M&A.
Honestly, Will, what you just mentioned is really rich in information. So thank you for that. And by the way, I don't know if you know this or not, but the interest in video gaming in the Middle East is huge. When we talk about Grand Theft Auto, PUBG, even FIFA, it's insane. It's insane. Even to the level that I believe the champion of the FIFA worldwide was from Saudi a year ago, Musa'id al-Dosari.
No, I mean, it's amazing. It's happening all over the world. But what is really interesting is if you look at games on a regional basis, similar to what you have in traditional sports, certain games are more popular in certain parts of the world. And that's why I think there's room for multiple players to kind of take advantage of that.
So far, this has been further than amazing. I'm pretty much speechless about it. Can you tell us a little bit more about the Nerd ETF?
Sure. So Nerd is our fund focused once again on video games and esports. Within the fund and how it's different, I think, than kind of the other video game ETFs on the market is really our focus on this concept of esports and game live streaming. I think when you look at what the next leg of growth is going to be in the industry, as I touched on, I think it's really going to be driven off of viewership. People watching other people game is still really, really new and unknown to a lot of people, even though it's immensely popular in Korea and in China, as well as social gaming. And for the Nerd ETF, we effectively have a similar portfolio construction to what I touched on earlier, whereby companies that are pure play and true to the theme receive a higher weighting than companies that are less so. And the types of companies that comprise the index are varied. So you have, at kind of the core, you have the video game publishers and software companies, the Activision Blizzards, Take-Two's, EA's, Ubisoft's. You also have the media companies that are touching on this live streaming and esports concept. So a couple names, example there would be Huya and Douyu, which are kind of their sister companies. They're actually scheduled to merge, but they are like Twitch, but for China only, where Twitch is banned. On top of that, we also provide exposure to video game hardware companies. So companies that are making and producing high-end gaming peripherals, whether it's headsets or keyboards that are used in competitive gaming, as well as chips and DRAM. So those are kind of the three main categories that make it up. When you look at the large cap companies that are exposed here, Tencent would be an example of a company that, through their investments, including Riot Games, including Epic Games, Supercell, and the list goes on, is very much so exposed to the theme as well. So really what I think the fund has benefited from over the past year has been twofold. One, the obviously the pandemic and the short-term impact that we're seeing in terms of that engagement. But I think more importantly, I think investors are starting to, particularly older investors, are starting to appreciate the size and scope of the games industry and understand once you're talking about 160 billion in revenues, this isn't just something your kids are playing. There's a lot of money that's being made in the sector, and that's resulted in increased inflows into our ETF and performance as well.
Since we're talking about ETFs, if you may tell us a little bit more about non-transparent ETFs and what are your opinions on them?
Mm-hmm. Sure. So let me start off by saying I've never launched a non-transparent ETF, so I'm maybe not the foremost expert on them. However, the general idea is really simple. A lot of sophisticated managers believe that there is information alpha, if you will, or that by not showing their holdings every day, and just to clarify, most ETFs for everyone show their holdings every single day on their website. So most ETFs, you can see exactly what they hold at the end of each day, sometime around 7 or 8 p.m. Eastern typically. The thought here is that, if you want to reduce the ability for people to copy your trades or to front run you, or anything else that could impact your performance, some managers believe that the better route is to utilize this new structure, which is non-transparent active ETFs, whereby, similar to a mutual fund, you don't have to disclose those holdings every single day. Instead, you only have to disclose them on a quarterly basis. So far, the structure has been adopted by primarily large institutional managers that come from the mutual fund world that are looking to get into ETFs. The adoption so far has not been very rapid and very fast. My personal view is that I think one of the best things for end investors, and this is why I love ETFs, is that there's full transparency. Investors can see exactly what you get every day. If you don't like it, you don't need to buy it. On top of that, I think what we've seen in ETFs that are active and transparent is, a lot of investors like to take ideas from ETFs and look at individual companies that ETFs are invested in. I think that's a good thing. So I'm a little bit skeptical that it will continue to that non-transparent active will carve out a meaningful share. It can make sense if you're very, very large to look at non-transparent active, where you want to be sure that no one is taking advantage of your transparency. But I still think that the active ETF wrapper makes a lot of sense with transparency. But I think that you will see more traditional mutual fund managers, whether it's Fidelity or otherwise, that test it. One thing I will say is that, if you recall from our earlier part of the conversation about how the market makers make a market in an ETF, it's kind of complicated what goes on behind the scenes in a non-transparent active, and I'm not fully confident of it. But the bottom line is that because they can't see everything at every point in time, the market makers, depending on which structure you're using, the spreads can be wider on the ETF because they have to account for the risk that they might not be perfectly representative of the underlying basket.
Definitely, the interest in ETFs is ever growing in the US, in the Middle East, and everywhere. This year, we've heard the word ETF maybe more than anything. So my next question is, what would be a good advice that you would give for anyone who's interested in entering such an industry as introducing ETFs or even offering financial products?
Yeah, I think. Sorry, I got a call while I was.
No worries.
And I didn't realize Clubhouse. I don't know how it works. I'm learning. I think in terms of entering the industry, I think it's the best thing to do is to try and speak with people that have done it. So reach out to me, reach out to others in the ETF industry or asset management industry more broadly, and try and understand what it takes, what they like and don't like about it, where and figure out what part of the, with any job, or any industry that you're looking to enter, what part of the operations really interest you, right? Are you more on the marketing side? Do you want to be a portfolio manager? Are you interested in dealing with the operations of how everything works with service providers? I think the more you can learn and speak with people in the industry, the better. I will say that, the ETF industry, the ETF is really just a wrapper, right? It's just another way to package an investment strategy that you may have. No different than a separately managed account or a mutual fund or a closed-end fund. I do think it is certainly the fastest growing wrapper, but at its core, you're still talking about asset management. And really, I think, the ETF is just one route. I think it gets a lot of love because it's on the exchange. Everyone can see how you're doing every single day. The transparency is there. But it's really to speak with not just people in the ETF space because it's somewhat small, but speak with people in asset management more broadly. And I think, that the more that, with anything, the more that you show that you're truly interested in a given sector and that you take the time to learn, the better chance you have of getting involved.
Now we'll shift the conversation to the questions from the audience. We already received a couple of good questions. So one of them is from Ziad Al-Bashiri. He's asking about your outlook for the next decade or 10 years for ETFs.
Oof, next decade's a long time. It's a great question, though. I think that ETFs are going to continue to take market share away from mutual funds. There's just too many benefits to the ETF structure when compared to a mutual fund, the least of which being the tax efficiency, which we didn't even talk about. But, I think that ETFs will continue to consume the mutual fund industry. And I think that gradually you'll see, we talked about non-transparent active, you'll see every kind of strategy under the sun that is doable make its way into ETFs. So we're already seeing expansion into different strategies within the ETF wrapper that we hadn't before. So we're seeing long short equity ETFs. We've seen ETFs that track CLOs. There's a lot of innovation that can continue to be done within the ETF wrapper. Of course, cryptocurrency ETFs are probably at top of a lot of people's mind as well. But the beautiful thing of the ETF structure and the arbitrage mechanism that we talked about earlier is, insofar as there's a robust underlying market, the ETF structure really does make a lot of sense. So I think it's going to continue to grow. I think the mutual fund industry is still much larger in terms of assets under management. That will shift. And I think you'll also see, it's adjacent to ETFs, but I think you'll continue to see innovation in the forms of kind of direct indexing as well, whereby individual accounts are able to kind of pick and choose and customize more what they're looking to do in terms of exposure. Besides that, we're hoping to do some innovative things that I don't want to share because if there's any ETF competitors on the call, I don't want to give away our ideas. But I think there's a lot of room for innovation within the wrapper, and I think it will continue to take share from mutual funds.
We'll keep close track of RoundHill Investments. So we have a question from Faisal Al-Kreda, and he is asking, what's the total addressable market of the gaming industry, and what's the compounding annual growth rate of it, and has COVID affected it tremendously or not?
Sure. I'll start with the second half because I think the TAM is a little bit difficult to contemplate. But in terms of, I mentioned 160 billion in terms of revenues for 2020, roughly. Pre-pandemic, we were growing high single-digit rate per year in terms of CAGR. Last year, we were higher than that. And I think, as I mentioned, kind of when we talked more about the games industry, I think that what we're seeing in terms of rapidly accelerating adoption and new users coming into the video game space, that the growth rate for the industry, in my opinion, is going to, at least for the intermediate term, longer term, who knows, but for the intermediate term, remain at or above that level that we came into the pandemic at. So I wouldn't be surprised if you saw low double-digit growth rates for the next few years. Obviously, when you get to an industry of that size, compounding at double-digit rates becomes more and more difficult over time. But I think when you look at the total addressable market, I think it's really, really hard to measure what that looks like. Like I said, I think such a big portion of the gaming story is driven off of new users from emerging markets that could never play a game before they got their first smartphone, and that smartphone penetration is going to be what, in my opinion, is the biggest driver of the TAM going forward. It's also important to pay attention to the technology that is being advanced in terms of cloud gaming, whereby regardless of your device, you can still consume AAA intellectual property. And I think that the kind of further down the line, the concept of games and digital realities and virtual worlds, like we're already seeing this play out with concerts inside of Fortnite and people hang out in Minecraft. Like the TAM, it depends on how you want to define games almost at a certain point, right? If I'm watching a Travis Scott concert inside Fortnite, is that even a game anymore, or is that like a virtual world? And I think that the concept of virtual world, when you introduce augmented reality and VR on top of it, which we've been hearing that story for years and it hasn't played out, but now you're talking about a TAM that I don't like. Is that like what the internet 2.0 means, right? So the potential really gets endless depending on how you want to define the concept of a game.
Okay.
Our last audience question. Our last audience question is from Abdelaziz Attas, and it's: what inspired you to start a gaming-focused ETF, and what is your favorite industry?
Sure. In terms of what inspired me, so I've always been, I guess you could say, a casual gamer. So I enjoy playing games myself. And I think that definitely played into it. But really, more than that, I think what we saw leading up to our first launch of the gaming ETF was, more attention. Gaming very clearly, particularly driven by Fortnite, took a shift into the mainstream in the West and in the US. And when we looked at, a lot of the investments and the investment opportunity that was happening in the space over that time period, including into esports teams or other assets, a lot of it was taking place in private markets. And for U.S. investors, in an industry that's so global, for retail self-directed investors in the U.S., there were only so many options for investors to get exposure, right? You have Activision, Zynga, Take-Two, EA, Glue. If you want to be generous, we said we think we can add a lot of value, particularly to younger self-directed investors who believe in this, who are gamers themselves, that know that this is maybe the media story of the future, that can't get exposure to the industry as a whole, because so many of these companies doing interesting things are listed in Asia or Europe or otherwise. So that was really what inspired it. That's how we knew we wanted that to be our first one. And what industry? I'm not sure. Is that which part of the video game industry? I wasn't sure what the last question was.
No, just in general, any industry.
Oh, I mean, I would say the games industry. Like, I continue to think that if you look at Gen Z, younger generations, what they're interested in is really driven off of agency, and social media has contributed to this a lot, and being involved in the forms of media and entertainment that they're interested in. I guess you could say at the highest level, I'm most interested in the TMT sector. Media and entertainment is really what fascinates me the most, and I think a lot of that is driven off of trends that are underlying the way that younger people think about the world. But I think games is so interesting. I mean, we're seeing this now with non-fungible tokens and crypto, and it's this concept of a virtual world that really, really intrigues me. And I think that games, as far as I can tell, are the closest to what that future might look like. I know that might scare some people, like, what, are we all just going to be spending time on the internet? No, when the pandemic opens, we're going back to normal. But there is something really interesting to me about that kind of digital future and what that looks like. And I think games are doing the most to kind of pioneer that future.
We expected gaming, to be honest, Will. And honestly speaking, with the development of NFTs and everything, we're excited for the future. Will, we cannot believe this hour just flew right away. We just passed the 10 o'clock timing. So we would like to thank you for your time and for everything. We enjoyed it, and we're also looking forward to see you in the future, communicating with you.
Absolutely. Thank you all for listening, and thank you for the time, and have a good night, because I know it's late there.
Thanks. Appreciate it, Will. Have a great weekend. Bye-bye.
You too. Bye.